Okay guys, so let's explore why should we top up during the market downtrend which is happening right now. So the following slides is prepared by me, Sam Sanjeevi, RFP, Registered Financial Planner, and Angel Win Shin Ming, my wife. We are both a unit trust consultants. So firstly, let's do a disclaimer. The purpose of this study is mainly for education use and not to be used to predict the future performance of any investment or funds. Now, although both of us are unit trust consultants, right? So the main thing over here is to give educations to everyone so that we can understand what should we do during the market downtrend. Okay, let's move on. Let's use an example in the unit trust funds. Mr. A invested at a price of 42 cents per unit, and then later on there's a bear market. Bear market means market downtrend. The price of the investment went down. So the price went down to 33 cents per unit. Mr. A will see there's a loss or unrealized loss in his investment. We call it unrealized. It's not a real loss, it's only unrealized. Paper loss, people call it. And then Mr. A did not do anything. He did not take the opportunity to top up or to invest more. Eventually, the price of the investment went up again to 42 cents per unit. So in this scenario, there's nothing changes. Mr. A does not make any gains. The investment only come back to nominal price. Break even, we call it.
So now we come to scenario B, where Mr. B invested in a price of 42 cents per unit initially, and when the price went down to 33 cents per unit, Mr. B take the opportunity to top up or invest more. And now, yes, the new average cost per unit is 38 cents, and the investment cost has been averaged down. Next, I want to show you what would happen when the price of the investment returned back to 42 cents per unit. So, when the price of the investment went back to 42 cents per unit, the profit growth for this scenario is 0.043 cents. This will be an 11% growth. Just by topping up during market downtrend, Mr. B gained 11% additional growth for his investment. So this is the positive effect of ringgit cost averaging. Ringgit cost averaging is an effective strategy we use in our investment. By practicing ringgit cost averaging, you can buy more units when prices are low, and this eventually will bring down your average investment cost. So, rather than trying to time the market by redeeming your investment when the market dips, stay focused on your long-term investment goals and take a disciplined investment approach by practicing ringgit cost averaging.
Okay, so now you know why we should top up our investment during market downtrend, because that will help us to gain better returns in the future. Now, there are also a lot of people tell us they lost faith on their investment in stock investment. Now, from this graph, I would like to show and to prove to everyone that equity or stock investment can be your best investment. This chart is actually from Morningstar, international company, where they take the data from 1926 to 2016. The chart is actually referring to US stock market the US government bonds, treasury bills, and also inflation. So from here you can see from 1926 to 2016, how many years? Altogether 90 years. How many events have happened? Global events, big events such as like war, World War we are talking about, stock market crashes, and there's many small and big kind of event, including September 11 and change of presidential and etc. So what is the result? If a person invested $1 in 1926, $1 only, what will happen to his $1 by the year of 2016 in various investment? Now, I would like to highlight these two investments, small stocks, small cap stocks, or the large cap stocks. So you can see that for small cap stocks, the investment have grown to $36,000. $1 investment become $36,000, and it is about 12% of return per annum for the past 90 years. Another investment which is $1 invested in the large cap stocks became $7,353. That is about 10% growth per annum for the past 90 years. Average growth is 12 to 10%. Okay, so you can see that eventually stock market will let us see the underlying fundamentals of the companies itself, and eventually it will grow, it will rise. So we are not telling people that you need to invest for 90 years. We are just giving an example why the longer you hold the investment, the better your investment will be, because eventually the stock market will rebound from the recession and you will be rewarded by the rebound itself. Market will eventually reflect their underlying economic fundamentals and earning growth. So rather than trying to time the market, we should stay invested and take the opportunity to top up during market downtrend. The best is to apply ringgit cost averaging. Thank you.